Treasury yields climbing to start the year, and really this movement higher that we have seen, a tremendous movement higher that we have seen in recent weeks. This after fresh inflation data, making investors a bit nervous about the outlook here for rate cuts and what exactly that timing is going to look like for the Fed. To break it all down and how to best position your portfolio, we want to bring in Gregory Peters, Co-Chief Investment Officer for PGIM Fixed Income. Greg, it's great to see you. So first, just taking a step back here, because it's going to be a very busy week here for the market. So much is riding on these earnings results, exactly what that is going to tell us here about maybe that momentum to the upside for equities. But what about the bond market, some of the trends that you're noticing here when you have the 2-year just shy of that 5% level?
Yeah, no, this is an incredibly important week. We have the micro earning reports coming in and lots of macro factors. So, I mean, what we're focused on is really what the Fed is going to say on Wednesday, which I think is not going to be all that interesting, other than the fact that Powell has to walk back being more dovish. And so the data has kind of worked against their earlier narrative. And so what I think you'll see coming from Powell and the Fed this week is, some more time, some more patience, and the prospect potentially for a rate hike, not a cut. And I think that is something that the market is incredibly focused on.
Greg, for a market that's been propelled by really 7 names that has now shrunk down to just a handful at this juncture, Alphabet and Meta really putting the team on their back for this earnings period here right now and accounting for much of the contribution to the earnings growth for its sector and information technology specifically. How going forward here can tech outpace or offset or even supersede where this higher for longer from the Fed is going to continue to be the talking point?
Yeah, so I think if you zoom out and look at the root cause why the Fed isn't cutting rates, it's actually a positive story, right? So the U.S. economy is much stronger than anticipated. Inflation, yes, above trend, a little higher, but that type of backdrop is pretty favorable for broad earnings. So I would be less focused from an investment standpoint on what the Fed is going to do and why they're doing or not doing such a thing. And if you look at it in that manner, it's a pretty positive backdrop for risk assets.
Greg, you just mentioned there a moment ago that the street is becoming a bit more focused on a potential rate hike. How likely is that from your standpoint at this point?
Well, I don't think it's the base case by any stretch, but if you kind of suss out what the market's telling you, it's about a 30% probability at this point. But it's the change from the start of this year, right? If you rewind the clock back to January, it was a fait accompli that the Fed was going to cut, pretty substantially this year. There was a narrative in the marketplace back in January that you would see 50 basis points in March, and clearly that hasn't happened. So it's the change, I think, that has taken the market by surprise. So, I do think it's a remote chance, but it's not a zero chance. And I think the market is getting its hands around that.
Where are there hidden opportunities right now that some investors would be apt to pay closest attention to, even outside of where the overcrowded areas of the markets are right now, from your perspective?
Yeah, so, I'm a fixed income investor, and I see a lot of value in fixed income. I think yields being as high as they are is a real inducement to get involved. I like the carry. I like the income. What you're also seeing is opportunities in the emerging market space, right? So, EM has kind of been left behind, I'd say, the past couple of years. But if you look at where the growth is coming, some of the disinflation really benefits emerging market economies more so. And you're seeing these programs come in for the more challenged countries that lifts up EM as well. So I kind of see it more broadly across fixed income, but EM is definitely a spot of interest.
Greg, when you take a look at some of the pricing action that we've seen within the bond market, and specifically just the moves that we've seen in yields, we've been placing so much emphasis on the movement to the upside, obviously, in the 10-year, how likely it is that we're going to get to that 5% level. Is that almost a sure thing at this point when you take a look at the fact that the movement is still, in most cases, here to the upside most recently?
I don't know if it's assured, but I do think it's a distinct probability and possibility. So, our range this year was 380 to 460 on the 10-year. We obviously pierced that. So we do see a real possibility of hitting a 5% on the 10-year. But I would say that's still a pretty decent level. And what we really like about fixed income in here is if and when the economy does start to slow down, we'll see some rate benefit as rate moves lower, and you get that capital appreciation.